Well, don't you look familiar? Yes, you. Time for me to do what I do best. Roast your finances. I'm your favorite sarcastic voice on the internet, back again. Today we're unmasking ETFs, exchange-traded funds, the investment everybody claims to understand, but secretly treats like a mysterious box at a masquerade ball. The truth? ETFs are what people buy when they want to look smart at brunch, but don't actually want to learn 50 stock tickers. They're financial yoga. Everyone says they do it. Nobody actually knows the poses. So what even is an ETF? Imagine walking into a grocery store. Instead of carefully picking apples, bananas, and whatever kale nonsense you pretend to like, you just grab the pre-packed basket. Done. Instant diversification. ETFs let you own a slice of everything without needing to pretend you read the financial statements. They trade like stocks, so you can panic about them in real time just like you do with Tesla or crypto, only now the panic is spread across 100 companies instead of one. That's called risk management, or as I like to call it, crying in bulk. Now let's be real, ETFs are masks. They're always hiding something. Sometimes it's a beauty mask, soothing and calm, the kind that makes you feel like a responsible adult. Except instead of glowing skin, you get slightly fewer financial bruises when the market drops. Other times it's Jason from Friday the 13th, standing behind the diversification costume, quietly hacking your returns into pieces while you convince yourself you're safe. And sometimes it's just a dental mask, not stylish, not fun, not scary, just plain boring. Practical, yes, but also about as exciting as waiting for your turn at the dentist while your friends are all at a nightclub. ETFs can be spot-a fabulous, horror movie terrifying, or painfully dull. And Wall Street happily sells you all three while convincing you you're making smart choices. Let's talk about the big ones first, the so-called responsible masks. The S&P 500 ETFs, SPY, VOO, IVV. These are the classic I'm disciplined and mature options. In 2025, they're up around 10 to 12%, which sounds great until you realize that's after a year of constant mood swings. Recession fears on Monday, record highs on Friday, and pure chaos by the weekend. These ETFs are the mask you wear to family dinner to look respectable while secretly screaming inside. Then there are the international ETFs, Europe, Asia, emerging markets. They sound exotic, but once you look under the hood, you realize it's basically America, but with extra paperwork. Respectable? Sure. Exciting? Not unless you think bureaucracy is thrilling. And of course, the themed ETFs. This is where the masquerade ball really goes off the rails. AI, space exploration, clean energy, cannabis, even pet care. It all sounds futuristic and edgy, until you realize every single one is secretly the same 10 megacap tech stocks in different costumes. You thought you were investing in the future of space? Surprise. You bought Microsoft again. It's financial catfishing. Commodities, though, they're the wild card. Gold and silver ETFs have been the real plot twist in 2025. Some shooting up 70, 80, even 90%. That's not diversification, that's gambling with glitter. Fun while it lasts, but most of you probably should have cashed out before you started betting next month's rent on uranium miners. Now here's where I need to confess something, and this is also where the disclaimer sneaks in so you don't tune out. I've been investing in ETFs. I thought I was doing the responsible, grown-up thing. You know, building wealth slowly, with discipline, like a financial monk. And what happened? Nothing. Absolutely nothing. I was sitting there watching my ETFs nap while my crypto portfolio was throwing fireworks, 40% up in a week. Pure chaos, dopamine everywhere. Meanwhile, I'm poking my ETFs with a stick going, "Hello? Wake up? Do something." Spoiler, they did not. And that, friends, is your reminder that this video is for entertainment and education only. I'm not your financial advisor. I can't tell you what to buy, and I don't know if your risk tolerance is higher than Elon Musk's tweet count. Do your own research before you pour rent money into anything that has the word ETF slapped on the front of it. Back to the masks. Let's talk about the fees hiding underneath. Broad market ETFs cost almost nothing, like 0.03%. Cheap, clean, responsible. But then you wander into the fancy ETFs with buzzwords like next-gen innovation, and suddenly you're paying 0.7%. That doesn't sound like much, but over time it compounds into a parasite, slowly draining your portfolio, while the fund manager orders another round of sushi. Liquidity is another trickster mask. Some ETFs trade so smoothly it's like sliding across polished marble. Others, it's like quicksand. You try to sell, and the bid-ask spread is wide enough to park a cruise ship in. Congratulations, you just tipped Wall Street just for letting you leave the party. Then there's concentration risk. ETFs market themselves as diversified, but once you peek under the mask, you realize 40% of the fund is secretly Apple, Microsoft, and Nvidia wearing fake mustaches. You thought you were buying an AI innovation ETF, but in reality, you just funded Tim Cook's yacht upgrade. And of course, tracking error, the karaoke mask. Your ETF promises to follow the index, but it sings off-key, misses the notes, and you're left wondering why your S&P 500 ETF is somehow performing like an awkward cover band at a dive bar. So what do you actually need to know right now in 2025? Fees matter. If you're paying more than 0.1% for a broad ETF, you're donating to some fund manager's weekend getaway. Volume matters too. High volume means you can trade in and out without bleeding cash. Low volume means you just bought yourself a financial hostage situation. The theme matters. If the ETF name sounds like a TikTok trend, it'll probably vanish like one. And the holdings matter most of all. Don't fall for the marketing costume. Clean energy might just mean Tesla and vibes. AI might just mean Nvidia and vibes. You probably already own them in your boring broad market ETF. The point is, ETFs wear masks. Some are beauty masks, steady, calming, good for the long-term health of your portfolio. Some are horror masks, hiding chainsaws, fake diversification, and hidden fees ready to slice you in half. And some are dental masks, dull, practical, unexciting, but protective. The mask you choose decides whether your financial story is a spa day, a slasher flick, or a dentist appointment. So why should you care? Because ETFs are the unsung heroes of not going broke. They won't make you rich overnight. They won't make you look exciting at parties, but they might make sure you don't die broke by sunrise. They're the line between chaos and stability, between chasing meme coins and still having rent money at the end of the month. And no, it's not too late. Broad ETFs are still doing their slow, steady climb. International ones are politely existing. Commodities are throwing their wild Vegas parties. The masquerade is still on. You just have to pick your mask wisely. Bottom line, ETFs are masks. Sometimes they hide beauty, sometimes they hide monsters, sometimes they just hide the fact that your money is sitting there half asleep, while the rest of the market feels like a nightclub. Choose carefully, or you'll end up starring in Financial Saw 6, The Portfolio Massacre. And before the credits roll, here's the part where you do the YouTube thing. Like the video, subscribe to the channel, and share this with a friend who still thinks ETFs are some kind of Wi-Fi setting. The algorithm is basically Michael Myers, always lurking, always judging, and only rewarding people who feed it clicks. Congratulations, you made it through the ETF haunted house. You now know the difference between the beauty masks, the horror masks, and the boring dental masks of investing. And the scariest mask of all, the one hiding those sneaky fees. So, I'll catch you in the next video, assuming you're not too busy dumping your paycheck into another genius investment that's definitely not just digital monopoly money. Don't worry, I'll roast it for you while you pretend you're still early.